This is David Ranson. Welcome to our client webcast for July 2020, which is on a theme. The theme is why rich valuations are usually not bearish for equity market performance. A record fraction of money managers, 78% according to Bank of America, currently believe the stock market to be overvalued. Once more. And as benchmarks for the market's fair value, PE multiples still get a lot of press. But the market has repeatedly penalized investors who act on this fear. Although this is a great mystery in common thinking, it's not the anomaly it seems. There are a substantial number of logical and factual pitfalls in identifying an apparently expensive PE ratio as bearish, in either the short or the long run. I'll begin by looking at the most widely cited valuation metric, Robert Shiller's CAPE, and then move back to more and more basic problems to which PEs are subject. Here are the questions I'll address. Is Shiller's version of the market's PE ratio more predictive than the simple PE? Does a high PE ratio reflect that P is unsustainably high or that E is unsustainably low? Do PE ratios imply a forecast of earnings performance or price performance or both? As a criterion, could earnings yield be superior to price to earnings? What role do dividends play in market price performance? Is norm reversion in the market's PE universally reliable? Is the supercorrelation between the market's PE and its multi-year performance as strong as advertised? Are there other ways the market's PE can be misinterpreted? What role does inflation play in the link between PE and future market performance? Shiller's version of the market's PE ratio is only slightly more predictive than the simple PE. That's the first point to make. Investors instinctively shrink from stocks when PE ratios are elevated, but this interpretation is vulnerable to the objection that earnings are highly cyclical. In other words, a high PE ratio could be telling us as much about earnings being low as about prices being high. By and large, in fact, the market's price level is less volatile than its earnings index, as you can see in Exhibit 1. The data shown cover the history of the S&P index and its forebears going back more than 140 years. Some years ago, this led Yale's Robert Shiller to propose substituting a 10-year trailing average of earnings in place of just the most recent year. Hence, his hugely popular cyclically adjusted version of the market's PE, the CAPE. But is it realistic to think that profits earned up to 10 years in the past are still relevant to current market prices? One way to judge the ability of an indicator to explain or predict the stock market is to divide the history of its annual behavior into high and low categories, or fractals. Then, to check whether subsequent market performance differs systematically from category to category. The left panel of Exhibit 2 illustrates the fact that over a 3-year period, the market returns 3 percentage points more after the simple PE ratio has been below the average than above. But the predictive power of CAPE in the right panel is only slightly better, a difference of 4 percentage points. The next point is that a high PE ratio may reflect weak past earnings performance rather than unsustainable past price performance. If markets do their job, there is something illogical about deriving a forecast of P from the ratio of P to E. That's because market prices are forward-looking and earnings are not. Forecasting stock market performance from a mere statement of present or past success implies a belief that the market is driven by alternating exuberance and panic, that it's emotional rather than rational. If that were generally true, the market's PE ratio would be driven mainly by the performance of P. Otherwise, variations in P over E would mainly reflect the volatility of E. Well, that's an empirical question, and Exhibit 3 shows the long-range historical evidence. In the left columns, there's a strong relationship between the PE and earnings growth up to 2 years prior. In the right columns, there's no relationship at all between the PE and prior price performance. So a high PE ratio tends to arise primarily from a recent downturn in earnings rather than a recent boom in prices. To that extent, using the current PE ratio to infer stock market prospects is looking at reality backwards. The next point is that PE ratios imply a forecast of earnings performance and not just a forecast of price performance. I've just talked about the close relationship between P over E and recent earnings performance as reflecting unusual fluctuations in earnings. That being so, as earnings normalize, there must also be a relationship with future earnings performance. In other words, it's just as reasonable to infer from a high PE a forecast that earnings growth will be high as a forecast that price performance will be low. Again, one test of relevance is to compare how the market performs after a benchmark is low or high, and Exhibit 4 confirms that the simple ratio of P to E is predictive for both subsequent price performance and subsequent earnings growth. Both relationships are significant, but the correlation with earnings growth is statistically the stronger. So the market's PE tells us less about whether stock prices are overvalued than it tells us about whether earnings will grow rapidly or slowly. What's true of the simple PE is also true of Shiller's CAPE metric, analysed in Exhibit 5. It's strongly related to future earnings growth and not merely to future price performance. So again, the evidence confirms that high PE ratios are at least as likely to reflect an unsustainably low level of earnings as they are to reflect an unsustainably high stock market. Next point, as a criterion, earnings yield is superior to price to earnings. There are additional basic objections to PE ratios as a valuation metric. For example, they entirely lose their meaning when the level of earnings approaches or falls below zero. This happened to the small cap stock market in 2014, ironically a time when the small cap outlook was bright. As Exhibit 6 shows, FactSet's version of the PE ratio for the Russell 2000 index spiked around 300, while Bloomberg had been obliged to cease publishing its version when it went to infinity. The same could also happen to large cap indices in particularly bad earnings quarters due to recessions or a wave of write-offs, and the fourth quarter of 2008 is one example of that. In periods of depressed earnings, such as the second quarter of 2020, it's clear that a major mathematical distortion can arise from the use of PE ratios. A simple solution is to turn the ratio upside down so that negative earnings no longer create an absurdity. Therefore, those seeking a valuation metric based on P&E should use E over P rather than P over E. Another point, market performance is more closely related to dividends than to earnings. Undistributed profits should arguably be as valuable as dividends in measuring corporate performance, but there's historical evidence to cast doubt on this. The market does not always behave as if earnings are economically relevant or trustworthy. It's no secret that corporate financial managers have some latitude to game their earnings, whereas there's no ambiguity about dividends paid to shareholders. As Exhibit 7 illustrates, the market's performance is inversely related to its past dividend yield. Moreover, a report we published more than 20 years ago showed that when dividends are substituted for reported earnings in the ratio of E to P, the predictability of price performance is superior. Further calculations found no relationship between the undistributed earnings yield and future performance. All of the predictive power of the earnings yield can therefore be attributed to one component, dividends. So, for practical purposes, investors would be better off paying attention to dividends rather than earnings. I want to turn now to norm reversion. It's intuitive to expect norm reversion in financial ratios, but this intuition is not universally reliable. Historical evidence gives another reason to doubt that an overvalued market can be recognized from its PE ratio. That's that low PE ratios tend to norm revert, but high PE ratios do not. This can be seen in a simple graph that divides the history of the PE ratio 1 year at a time into quartiles, and in Exhibit 8 the second and third quartiles are combined into a single intermediate category. The graph shows an oddly mixed picture. Low PE ratios do tend to rise over time, that is, norm revert. But on the average, high PE ratios tend to persist rather than decline. If convergence from high PE ratios occurs at all, it's too slow to measure how long it takes. Some investors prefer to express PEs in terms of earnings 1 year ahead, as opposed to trailing, but for the present purpose, the difference is immaterial. Next, the supercorrelation between the market's multi-year performance and its PE is far weaker than advertised. We now turn to the longer-term outlook for stocks based on valuation. It's now recognized that PE is an unreliable basis for predicting equity returns over the near or intermediate term. But over horizons of 7, 10, or 12 years, valuation is still said to be powerfully predictive. Some claim that valuation explains more than 90% of the variation in decadal market performance. It looks that way in Exhibit 9. The correlation between Shiller's CAPE statistic and subsequent 10-year S&P performance appears at first sight to be a near-perfect minus 0.98, as illustrated for the past 30 years. But such interpretations are mistaken. Even if the time frame were lengthened from 30 to 60 years, there would still be only 6 decadal observations that are independent of each other. The use of monthly overlapping 10-year time frames destroys the independence among data points. It overstates the number of degrees of freedom in the sample by more than 2 orders of magnitude, and it greatly exaggerates the closeness of relationship. After expanding the sample in the Exhibit 9 to 6 decades, the correctly computed correlation is much lower. Exhibit 10 shows a picture of the relationship over the past 8 decades, unbiased by overlapping data. The corrected correlation, minus 0.66, still looks okay, but it overstates the truth due to a hidden mathematical tautology. The level of stock prices, current P, appears both in the numerator of the valuation metric, P over E, and in the denominator of the subsequent performance measure, P 10 years out relative to P in the present. The tautology creates a bias in the measured inverse correlation. If valuation were entirely unrelated to future performance, the tautology would still make it look as if it were. A rough correction for the distortion leads to the conclusion that PE explains only about 25% of the variation in subsequent 10-year stock market returns. Apart from all of these pitfalls, there's still another way in which the market's PE can be misinterpreted. The limited predictive power of PE ratios might be attributable to the role of inflation in promoting market performance. The market's PE has long been known to be higher in times when inflation is low or absent. Exhibit 11 shows that both a low rate of inflation and a declining rate of inflation promote PE ratios. And history shows that few situations are more bullish for the stock market than a benign inflation atmosphere. So it may be no accident that PEs have been higher than expected during recent decades, at times when low inflation has characterized the US economy. Could it be that PE ratios are a proxy for the effect of inflation on market performance? One powerful financial market indicator of low or falling inflation is a stable or declining price for gold. Exhibit 12 shows the close relationship between the market's earnings yield and inflation as measured by annual changes in the gold price. Gold price movements do go a long way to explain ups and downs in price-earnings comparisons. Low inflation may therefore be a key factor in resolving the valuation puzzle. It promotes both a high market PE and strong subsequent performance. And that undercuts the ability of PE ratios to forecast the market or to function as an indicator of valuation. So our conclusions are these. Shiller's version of the market's PE ratio is only slightly more predictive than the simple PE. A high PE ratio may reflect weak past earnings performance rather than unsustainable past price performance. PE ratios imply a forecast of earnings performance and not just a forecast of price performance. As a criterion, earnings yield is superior to price to earnings. Market performance is more closely related to dividends than to earnings. It's intuitive to expect norm reversion in financial ratios, but this intuition is not universally reliable. The supercorrelation between the market's multi-year performance and its PE is far weaker than advertised. Apart from all these pitfalls, there are yet other ways in which the market's PE can be misinterpreted. The limited power of PE ratios could be attributable to the role of inflation in controlling market performance. I'd like now to introduce my colleague, David Campbell, who represents us in the United Kingdom, and he's prepared some questions for me to try to answer.
Looking back at the Great Recession, the recovery in economic activity was slow by historic standards, despite the massive QE programs of the Fed and other central banks. This seems to have reflected the fact that QE did not lead to strong bank lending and money supply growth. Now that the US Treasury and other financial ministries are pressing resources directly into the hands of individuals and businesses, can we expect more rapid results?
Good question. It's not been tried before on anything like this scale. To be sure of the answer, we'll have to wait and see. But history is not encouraging. Back in 2008, the US Treasury doled out large transfer payments to major financial institutions that might otherwise have gone bankrupt, while at the same time hampering them with heavier regulation to deter them from making risky investments. At the very least, such government spending has to be financed with debt. The net result of all of these federal efforts was an unexpectedly slow recovery. This time around, much of the money is going to individuals, families, and small businesses. To some extent, that's justified on humanitarian grounds, but not on purely economic grounds. I don't know of systematic evidence that any kind of transfer payments speed the economy up. Logically, it seems unlikely. Unearned income reduces the urgency with which recipients make the effort to seek work and reconstitute their financial stability by themselves. It makes them less resilient and postpones the contribution they could be making to the economy.
As I understand it, there is evidence that savings rates have risen in the USA, so the government handouts are not all being spent. This surely impedes a recovery in output, particularly as so many are being paid to do nothing.
Actually, there is nothing unexpected about not all government handouts being spent. That is normal economic behavior. Accepted consumption theory, originating from Milton Friedman's permanent income hypothesis, says that most of transitory income is saved. It's empirically established, but implies a fault in Keynesian economics that has never sunk in. I would not, of course, expect it to apply to alms for the destitute. The idea that saving impedes recovery is a related false axiom dating all the way back to Keynes himself. It has huge implications. But recovery requires that capital be put to work. Saving creates capital. Spending doesn't. This is classical logic, and together with the history we have for previous shutdowns in the US and even in the more heavily regulated UK, suggest a complete snapback to the track that the economy was on before the crisis. I still expect a 10% jump in real GDP in the third quarter, cancelling out the 9.5% drop in the second.
David, you have been viewing the significant advance in the gold price as a panic for safety rather than a signal for impending inflation. How can we distinguish these two potential gold price drivers at any point in time?
I don't know of a confident way to make this distinction in practice. Safety comes in a number of flavors. The gold market is driven by anxieties about geopolitical and monetary stability. Stock and high-yield bond markets are driven by anxiety about the economy's ability to cope. So in a crisis atmosphere, it's unsurprising to see stock and high-yield markets doing well while gold rises. In normal economic circumstances, the opposite is the norm, because monetary instability and inflation are bearish for the economy. A surge in the price of gold that is accompanied by an acceleration in the rate of increase in consumer goods prices would imply inflation. There is no sign of that. The present surge in the price of gold without such corroboration is likely to reflect geopolitical anxiety or fears relating to the continuation of the pandemic. If a vaccine makes its appearance, this logic implies a fall in the gold price. but I expect a vigorous rebound in the economy with or without a vaccine.
Following the US Q2 GDP fall of 9.1% versus Q1, can we expect the economy's usual resilience to manifest itself in the current quarter when the federal and state governments continue to mandate various restrictions on normal activity?
Yes, shutdowns and restrictions are increasing again, it is true. Though highly publicised, they are much more selective than in the first round, mostly in hotspots and urban areas, and they are going to be far less popular than during the much more fear-ridden first wave. Meanwhile, during the nationwide shutdown, the business sector was learning how to work around pandemic-related limitations. I further suspect that production has begun to migrate from urban to rural parts of the country, and that this migration of economic activity will go on for years to come, taking people along with it. In the future, a greater part of the labour force will work from home, and with lingering fear of future pandemics, cities will be less productive, while the provinces will be more productive. Ironically, this will make the economy more resilient than before, because intensive regulation and high taxation are largely an urban phenomenon. I'd like now to thank you, David, for his questions, and now we move on to topics for future publications. 1. Is the world deglobalizing? 2. Do tips serve as an adequate proxy for real interest rates? 3. Economic policies should promote resilience as well as relief. 4. Do transfer payments boost or speed up an economic recovery? And 5. The price of oil in an economic rebound. That's the end of our webcast for July, and we'll have another one in September when we'll look mainly at the incoming economic and financial information and capital markets. Thank you for listening, and I look forward to the next time.